Welcome to the Explainer, everyone. I'm absolutely thrilled you're here. Look, our goal today is simple, but it is literally a game changer for your wallet. We're going to demystify those incredibly dense IRS rules and unpack the massive new OBBL legislation, all so you can keep way more of your hard-earned money. You know, taxes really don't have to be this big, stressful mystery. With the right setup and knowledge, you can absolutely take control of your financial future. Let's get into it.
Okay, so let's dive into this. Have you ever wondered if your standard W-2 habits or everyday investment strategies are actually costing you thousands of dollars? Because for so many hardworking professionals out there, the answer is, unfortunately, yes. But hey, that stops today. We're going to look under the hood of the tax code so you can stop leaving your own wealth on the table. All right, here's our roadmap for the Explainer. We're kicking things off by decoding the 2026 tax brackets, then checking out the new OBBBA tax breaks and expanded HSA benefits. From there, we'll expose some common W-2 tax traps you've got to avoid, navigate the tricky waters of capital gains, and finally, lock in some pro-tax-saving tactics.
Section 1. Decoding 2026 tax brackets and understanding your federal baseline.
Before we can start optimizing, we really have to understand how the U.S. progressive tax system actually works, right? I mean, you can't play the game if you don't know the rules. So let's bust some jargon right out of the gate. People always panic about getting a raise because they think, oh no, moving into a higher tax bracket means I'll actually take home less money. Guys, that's a total myth. We have to clearly distinguish between your marginal tax rate, which is just the rate you pay on your very last highest dollar of income, and your effective tax rate, which is the total blended percentage of your income that actually goes to taxes. And this brilliantly illustrates exactly how progressive taxation works. Think of it like a layered cake. The U.S. system taxes your income in progressive layers. You only jump to a higher rate on the specific dollars that cross these 2026 thresholds. So if you're a single filer earning $55,000, well, only the money above $50,400 gets hit with that 22% rate. The rest of your money, it's sitting comfortably at those lower 10 and 12% rates. Makes a lot more sense now, right?
Moving right along to Section 2, New OBB Tax Breaks, or what I like to call the Legislative Expansion Pack.
Now, let's shift gears to some recent legislation, the One Big Beautiful Bill Act, or OBBBA. Looking purely at the financial mechanics here, OBBBA introduced some genuinely sweeping income deductions. Get this, eligible workers can now deduct up to $25,000 in tips. Plus, there's a massive overtime deduction, up to $12,500 for single filers and double that for joint filers. Seniors get an extra $6,000 deduction. And even if you just take the standard deduction, you can now write off up to $1,000 as a single filer for cash charity donations. Just keep in mind, things like the tips and overtime deductions do start to phase out at higher income thresholds.
Okay, here's another massive legislative shift. $40,000. This is the newly expanded SALT, or State and Local Tax Deduction Cap, specifically for taxpayers with a modified adjusted gross income under $500,000. For years, folks in high-tax states were stuck with a $10,000 cap, basically paying federal taxes on money they'd already handed over to their state. It was super frustrating. But this new $40,000 cap, it makes itemizing your deductions incredibly attractive again.
And here's another number you're gonna want to remember, $10,000. This is a super unique OBB edition. So if you purchased a new U.S. assembled vehicle in 2025, you might be looking at a potential deduction for up to $10,000 in loan interest paid on that purchase. Now, it does phase out for higher earners, but man, it's a fantastic break if you qualify.
All right, Section 3, Expanded HSA Benefits. Let's talk about the ultimate retirement stealth account.
Listen, if you've got a high-deductible health plan, the Health Savings Account, or HSA, is arguably one of the absolute most powerful wealth-building tools in the entire tax code. No joke. And the secret sauce here is the rare triple tax advantage. Check it out. The money you put in, up to $4,400 for individuals or $8,750 for families in 2026, is tax-deductible. Then, those funds grow totally tax-free. And on top of that, withdrawals for medical expenses, you guessed it, entirely tax-free. Because these funds roll over permanently, savvy W-2 earners are actually paying for their current medical stuff out of pocket and treating the HSA like a stealth retirement vehicle, just letting it compound tax-free for decades.
Now, what's really interesting about this is how OBBA retroactively expanded who actually gets to use an HSA. Before this, a lot of bronze or catastrophic plans on the individual exchange didn't technically qualify as high-deductible health plans, all because of some quirky rules about out-of-pocket maximums.
Well, OBBA changed the rules, meaning way more people with these individual plans can now legally open an HSA and capture those incredible tax benefits.
Oh, and OBBB also updated the rules around Direct Primary Care Service Arrangements, or DPCSAs. Basically, these are setups where you pay a flat monthly fee straight to your primary care doctor. Under the new law, paying that fixed fee, up to $150 a month, no longer disqualifies you from contributing to your HSA. And it gets better. You can actually use your tax-free HSA funds to reimburse yourself for those monthly fees. How cool is that?
Moving right into Section 4, Common W-2 Tax Traps. Time to look at the hazards that are quietly costing you money.
Okay, we've had our fun with the benefits, but now we really need to have a heart-to-heart with all the W-2 earners out there about the hazards. If you just ignore your taxes until April, you're almost certainly falling into some traps. The biggest one? The W-4 withholding trap. Look, your W-4 is literally just an estimate. If you're getting a massive refund every single year, please do not celebrate. You essentially just gave the IRS an interest-free loan of your own money all year long. On the flip side, if you underpay, you're going to get slammed with a huge tax bill and potential penalties. Remember, any major life change, getting married, having a kid, buying a house, means you need an immediate W-4 adjustment so your paycheck accurately matches your actual tax liability.
Then there's the RSU surprise, which, wow, it is absolutely devastating for tech workers and high earners. Restricted stock units are taxed as ordinary income the exact moment they vest. That entire value gets slapped right onto your W-2. The trap here, companies usually only withhold a standard 22% for taxes. But if you're a high earner, your actual tax bracket might be up at 32 or even 35%. That gap accidentally pushes you right into a massive surprise tax bill on equity you might not have even sold yet. It's brutal.
Section 5. Capital Gains and Investing. Let's navigate the world of asset taxation.
As you start building real wealth, you naturally transition from just earning a W-2 salary to actually selling assets. We're talking stocks, bonds, real estate, the whole shebang. And the way those assets are taxed is a completely different ballgame. Everything in this world revolves around your cost basis. This is basically what you originally paid for the asset plus a few specific adjustments. Miscalculating your cost basis is a major, major trap because it dictates the exact amount of profit that the IRS can hit with the capital gains tax. Remember, you don't pay tax on the total sale amount, just the gain above your basis.
So the crucial point here really comes down to the timeline. If you sell an asset after holding it for 1 year or less, that's a short-term capital gain. And it gets taxed at your ordinary income rate, which, as we saw, could be as high as 37%. But if you just hold that asset for 1 year and one single day, boom, it becomes a long-term capital gain, which is taxed at highly favorable rates of 0, 15, or 20%. Selling an asset before you cross that 1 year mark, it's an incredibly costly unforced error.
And finally, Section 6. Pro-tax saving tactics. It's time to start playing offense with your wealth.
All right, it's time to take everything we've learned today and shift from playing defense to playing offense. Let's talk about an amazing strategy called tax loss harvesting. Here's the play. Step 1, you sell an underperforming investment at a loss. Step 2, you quickly replace it with a reasonably similar asset so your portfolio stays perfectly balanced. And step 3, you use that realized loss to cancel out the taxes on your gains, or even to offset up to $3,000 of your ordinary W-2 income. It's genius! Just be very, very careful of the wash sale rule. You absolutely cannot buy a substantially identical asset within 30 days before or after the sale, or you completely lose the tax break. So watch your dates.
Another pro tactic we love is called bunching deductions. Let's say you generously give to charity every single year, right? But your total itemized deductions always fall just short of the standard deduction limit. Well, that means those charitable tax breaks are essentially just lost to the void. But by bunching 2 or 3 years' worth of donations into a single calendar year, you can confidently blast right past that standard deduction threshold, capture the tax break in full, and then simply take the standard deduction in your off years. It's all about timing. And that brings us to one final critical question. Are you playing defense with your taxes, or are you playing offense? Guys, we really have to stop treating taxes as the stressful, panic-inducing event that just happens to us every April. By understanding the brackets, leveraging the heck out of those HSAs, avoiding W-2 withholding traps, and actively harvesting your investment losses, you can proactively protect your wealth all year round. Do not leave your money on the table. Take these tactics, apply them, and start building your financial future today. So what's your very next move going to be?
Thanks so much for joining me on this explainer, and I'll catch you next time.